I am live again on this Sunday afternoon. So, what I'm about to go over, based on the title, is how you should read your financial statements. So, I know a lot of your business credit gurus, they don't talk about the financial statement portions of you as a business owner and like knowing your numbers. You should actually know stuff like that, especially if you ever want to get high dollar amount, high lines of credits. So like $500,000, $300,000, or $1 million lines of credit from a bank. If you ever want to do that, or if you ever want to grow your business to a certain level, you should know these type of information because the bankers will pretty much, I say, look at you differently and know you and treat you with more respect if you know your numbers way ahead of time because it's like a Shark Tank pitch. So a lot of stuff that I'm about to go over today is what I learned from the Golden Sachs stuff. And I just created a PowerPoint slide and I actually used AI to create this slide in 3 seconds. I just edited it. So these are some of the key things that you need to keep in mind. I'm also creating, this is like a snippet from the course and stuff that I'm creating that I'll be launching probably in like a few months. That goes over like some basic chart of accounts you need to have set up in your business. So this is good for like if you're a brand new business, you're just now starting up. Or even if like you're a seasoned business owner, but you don't have your book set up and you don't know what none of it means, and you don't have like a financial advisor, not a financial advisor, that crap. You don't have an accountant or a bookkeeper, or like a CFO that you use or a fractional CFO that you can contact. That way, you know what these numbers are and mean. So, without further ado, let me go ahead and share my screen so we can go ahead and get into this joker and I can go eat later on. So, like I said, do not laugh at my slides because I made it in like uh, 3 seconds. So, let's go over analyzing financial statements through ratios, a comprehensive guide. Artificial intelligence is amazing nowadays. I wish I had this when I was in college. I probably wouldn't have stressed and killed myself so much. But I probably would have still did it because I like doing stuff on my own. But now time is so limited, I need to learn how to do other stuff. But anyways, let's go ahead and go to this introduction and this quick presentation I'm going to give to each and every one of you. So it's going to go over like the basic, the most important financial ratios because you don't really need to know all of them, especially in your business and accounts, the charts that you have. But I'm going to go over like the formulas you're going to use to interpret it, to go over your company's financial health, because depending on what kind of business that you're running, depending on what kind of industry that is in, these numbers is going to matter completely different. So let's say that you're in the management sector, you're in the real estate sector, or if you're in the spa sector, or which is healthcare sector, you have different ratios and different numbers you need to compare your business to make sure that your numbers is actually correct or not. So you shouldn't compare a consulting company to a healthcare company. The numbers I'm about to go over right now. So, yep, let's go over. Let's go ahead and go to the next slide. So the liquidity ratios. What this does is it determines how liquid your company is. So you got two ratios you need to know about: the quick ratio and the current ratio. These ratios help investors assess a company's ability to pay off its debts as they come due. Now, to know all this information, you should have your book set up properly. So you should have a bookkeeper and an accountant, or just a bookkeeper. And not remember this: not all bookkeepers or accountants is created equal. I wish I could tilt this, but I can't. They're not all created equal, so you need to get recommendations. But luckily, to the people that's going to be inside of my entrepreneur funding stack, I'm going to gift you a free chart of accounts, which is the standard that you're going to be able that you should need and use in your business. It's a standard throughout all businesses. So let's go over what these ratios are. So you got the current ratio and the quick ratio. So the current ratio is your current assets divided by your liabilities. It's got to be greater than one. This shows that your company is liquid and that your assets is not, you're not overly leveraged. And you got the quick ratio, which is current assets minus the inventory divided by the current liabilities. And it should be as close to one as possible. So later on in this slide, I'm gonna go over I'm gonna look at the balance sheet. I put up a quick balance sheet in the different tabs so I can go over like where you can find stuff like this for your business, stuff like that. So let's go on to the next profitability ratios. So what this means is, yeah, it's pretty much self-explanatory. It measures a company's ability to generate profits relative to its revenues, assets, and equity. So return on equity is not that as important, especially starting out. What you really want to pay attention to is not on this particular slide right here, is gross profit margin, net profit margin, and operating profit. Those are super important. You should make sure you track that monthly, quarterly, and even yearly. So these ratios help investors, heck, even yourself, measure the company's profitability and efficiency. If you ever want to sell a company, you need to make sure you got like a 2-3 year window. And whenever you're comparing the number to see if your company improve or decrease, you need to compare based off of like years. So you have like a trailing number. If you don't have years, to do months. So the formulas for some of this stuff: net profit margin is net income divided by sales. That's what net profit margin is. Your gross margin is your gross profit divided by sales. And your operating margin is your operating profit, otherwise known as EBIT, divided by your sales. So operating profit, EBIT. EBIT stands for earnings before interest and taxes. You got EBIT and you got EBITDA. EBITDA is maybe you subtract like your credit card payments and your interest payments. That is after all that stuff. So that's earnings before interest, taxes, depreciation, and amortization. So at this point, let me see. So let me stop sharing this tab. Actually, let me stop sharing real quick. I want to go over to some sample income statements and balance sheets. That way we can like compare this stuff too. Fresh book. All right. Here goes a sample income statement right here. So what I was just going over, let me go back to this other tab. I was just going over net profit margin, gross margin, and operating margin. So operating profit. Right here, you see you got operating income right here. So that's otherwise. It just depends on the terminology and like how they define it in your balance sheets or your income statements and QuickBooks. So you can either use QuickBooks, Wave apps, or FreshBooks or FreshBooks. You got like, what is it? One of those companies that Cody Sanchez had bought. I forgot which one it is. They don't use QuickBooks, but it's a lot of companies or other like providers you can use to like upkeep your books. So you got this income statement right here. Sales, just total sales right here. Then you got, this is like complete revenue. You got cost of goods sold. I'm gonna go over this in depth later on in the presentation because you'll be surprised, and this depends on your sector, what cost you got: cost of goods sold and cost of services. So I learned most of this from the Goldman Sachs stuff. You should include like your employee expenses inside of cost of goods sold or cost of services. But you should also keep separate track of your books. You got management section books, which is like internal to your company, and then your books that you provide to your CPA. Now, how you keep that separate? You talk to your accountant, but you should most definitely keep that separate because for tax time, you're gonna give separate books to separate people. But with your cost of goods sold, the cost of goods services, the cost of services, how you want to pronounce it, you should include employee expenses in that. But yeah, you got this, and this is your gross profit. Damn, it's high. These costs of goods sold is high. Anyways, gross profit. So let's go back. Let me go back here. You got your gross margin is your gross profit divided by sales, which is like revenue. So you divide this, and that tells you what your gross margin is. Now, there isn't a specific number or percentage that you need to be able to compare this to. What you should compare this to is your company's industry sector. You can grab that information using AI or Google. Just Google like management consulting revenue sector revenue percentages, like the common gross margin percentages for this particular industry. You can either hop on ChatGPT, Perplexity, or just Google the information and it's just gonna pop up. All right. So your operating income, you take this operating income right here, and you're gonna divide it by, which is your EBIT. You're gonna divide it by your revenue. So sales is revenue. So your operating income divided by sales is gonna give you your operating margin. You should most definitely keep track of that every single month. All this is going to lead towards you getting that massive line of credit and knowing how to be bankable in the business world. Nobody talks about this on social media because it's boring, But once you get past of all of the getting lines of credit without using any income, no doc, and stuff like that, you need to know this information. Like I said, if you ever want to pitch to an investor, go to a bank and stuff, whatever it means. Okay, so that's that. Let me go back to let's go back here. Stop sharing. Man, I don't know how to share this again, bro. Great. Let me see something. Well, I don't know how to share that full screen again, so I'm just about to share the whole window. Hope y'all can see this. All right, cool. We go back. But yeah, efficiency ratios. This goes over like if you got inventory or accounts receivable. Nobody's on, but the replay is going to be showing. So you got accounts receivable. That what accounts receivable is if you're collecting payments on credit. So you collect the payments on 30-day terms, 5-day terms, and things of that nature. The turnover ratio means how long does it take for you to collect your money. A line of credit is very useful for stuff like this. So a lot of people that's connected to me or that's following me all over social media is nothing but real estate investors. Real estate investors don't have AR unless you have employees. So, but if you in the like retail space, any other space where you have inventory, goods, or perishable items, like knowing this stuff is very, very important. And just so you know, a lot of banks don't like lending to companies that got perishable goods. So just keep that in mind. These ratios help investors assess a company's operational efficiency and effectiveness. So how quickly you can turn this over, like sell it, get it in and get it out, and that's how quickly blah, 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 how quickly you can collect your money. Yeah. So this is how you this is how you calculate that. You got accounts receivables, AR turnover. It's calculated by your revenue or sales divided by your accounts receivable. Now this is a dollar amount. It's going to be the sum of that, with the sum of your AR. And your inventory turnover is your cost of goods sold divided by your inventory. So that's how you calculate that. This is how quickly you can actually collect money in and out, how quickly you can turn over or sell your inventory products. Now you got cash flows. Cash flow statements, vital financial documents. So you got these 3 documents you should know about. It's like from Rich Dad Poor Dad. You got your balance sheet, financial statements, and your cash flow document. QuickBooks actually generates all this stuff for you, but you just gotta, like, once again, make sure you're collecting this stuff and keeping track of it properly. Some key terms to know is your operating cash flow, just the difference between your revenue and your expenses. You do gross profit if you want. Accounts receivable days outstanding. You got inventory days on hand, accounts payable days outstanding, and your net operating cash cycle. Okay. So this helps owners, managers understand your company's liquidity, financial health, and all the stuff that you need to know. This is how you calculate this stuff. So this is defined by the year. So 365 days divided by your AR turnover. So you calculate the AR turnover in the previous slide. The inventory days on hand, same thing, divided by the inventory turnover, then accounts payables days outstanding. This is how long it takes for you to pay off your vendors. The longer, if you compare this like between previous months or previous years, and you see that it's going to take longer for you to pay off stuff, this is where a lot of credit comes into play. You have to float these payments for these expenses, go back and negotiate with your vendors, blah, 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 stuff like that. You got net operating cash cycle too. Inventory days, AR days minus AP days. Not net operating cash cycle. Kind of weird about that. You don't care about that. Now, like once again, this depends on your industry. So this covers every single business on planet Earth. Well, actually, yeah, planet Earth. Then you got this stuff called solvency ratios. This is how quickly this measures the company's ability to meet its long-term obligations. So long-term liabilities. You got debt to equity ratio and interest coverage ratio. Interest coverage ratio is also something I think is called times bearing interest, something like that, otherwise known as debt service coverage ratio. It helps investors evaluate a company's financial risk and the ability to repay its debts. So, financial leverage. This stuff, pay attention to these formulas actually right here. This don't matter as much as this does. These are the numbers you actually want to pay attention to. You got financial leverage. This is how over leveraged you are. You take your total liability, you're going to divide it by your equity. I'm going to show you something on this balance sheet that you should know. This is how you know if like you're a CPA or bookkeeper, not CPA. I'll go over that later. Your accountant and bookkeeper is actually keeping your books properly balanced because your owner's equity needs to match your total liability in the QuickBooks world, in the financial statements world. And I'll show you what I'm talking about. And this can't go over 3. Can't go over 3. And the debt service coverage right here, the operating profit, this interest expense, well, how you calculate debt service coverage is operating profit, which is the EBIT divided by interest expense. This needs to be greater than 1.5. If you ever walk into a bank and any of these numbers, they look over your balance sheets and any of this stuff is not right, they're gonna deny you. You can't pay it. You can't pay the debt. You can't pay an extra loan if the total liability divided by the equity is over 3 and your EBIT divided by the interest expense is greater than 1.5. Well, less than 1.5. If it's any of that, your likelihood of getting approved for that massive line of credit is going to be super low. Before I forget, let me go back to this balance sheet. So what I was talking about, this right here. So this is like I was talking about before. This is how you know if your books is not balanced properly. Your total assets needs to equal your total liabilities plus stockholder equity. If this does not match each other, right here, oh crap, I'm not sharing this. Anybody say anything? Nope, nobody saying nothing in the comments. All right. Wish I would have said so. So your total assets, now like I was saying before, your total assets, this right here, I can't highlight, needs to equal your total liabilities plus your stockholders' equity in your QuickBooks. If it doesn't, then that means your books is not balanced correctly. This must equals each other. So yeah, let's go back here. And that's it. That's the conclusion. So I just went over what exactly you need to know and what exactly you need to follow in your company's books. Whenever you walk into a bank and you want to ask for like a $500,000 up to $1 million line of credit from the bank, or even a loan, because at those dollar amounts, they're gonna either ask you to put up collateral or put together some form of an investment sheet why they should give you that dollar amount. All right. So what I'm gonna do, let me see here. I want to know. Let's see. Should I share this? I don't think I should. Maybe I should. Maybe I shouldn't. Probably not. So I want to share. Well. Once I post this, I'll see the recording in the comments. If you guys want a copy of standard chart of accounts that you need to have your books set up as, and if you want a link to what else do I have? The chart of accounts, probably. Yeah, if you want a copy of the chart of accounts, let me know, and I just share the URL somewhere here, probably in the comments on Facebook or in the comments or in the description on YouTube. That way you can get it. So that's the end of this presentation. This is like the coming financial terms you need to know in your company. If you don't have a CFO, a fraction CFO, an accountant, or if you want to make sure your accountant and your bookkeeper is actually keeping you right on track. So this is stuff you need to know. Walk to a bank, get a master line of credit. So that's all I got, y'all. I'll post that if you guys want it. See you later.